Hi, I'm Jim Jubak, and welcome to my YouTube video. It's a beautiful spring day here in New York. It's 70 degrees, or headed up to 70 degrees. Coming down from the north, I stopped at a bush that just seemed to be full of bird song of all kinds, and I kept looking and going, well, there must be 20 or 30 birds here. No, it was 2 mockingbirds. I heard them run through their repertoire of about 7 or 8 bird calls. I love mockingbirds just because they're like a biological little tape recorder. I stopped to look at him, and while I was there, I noticed that there was a big white heron walking along the opposite bank looking for frogs. This kind of sighting always reminds me of one of my favorite urban wildlife books. It's a book by Jerry Sullivan from 2004 called Hunting for Frogs on Elston. It's about looking for urban wildlife in Chicago. Remember that you can find more of my picks, portfolios, etc., market commentary on my free site, jubakpicks.com. You can find even more portfolios, 6 as opposed to 3, even more frequent posts on my subscription site, jubakam.com. As always, if you like this video, like it. And please subscribe to it on YouTube, because that will give you notification when a new one is going up. We're doing about 1 of these a week. So I'm calling this 3 more stock picks for earnings season. It's really sort of short-termy stuff that seems they're going on, because earnings season started off today with big bank earnings from JP Morgan and Wells Fargo. And JP Morgan is really indicative of how tricky this is. So let's look at a chart. So JP Morgan reported this morning before the market opened, and it just blew estimates away. For the first quarter, it reported earnings of $4.50 a share, and that beat analyst estimates not by a nickel, a dime. It beat by $1.38 a share. Revenue at $32.36 billion, beat by almost $2 billion. Okay, and what do you see if you look at the chart? You'll notice the stock is down. Expectations were so high, and there's stuff in the earnings report that makes you sort of go, oh, okay, because a lot of this is unwinding of money that they put aside against further losses, because they're thinking they're not going to see as many losses. And Jamie Dimon did come out and say, CEO came out and called loan demand going forward problematic. He then had to come out with the correction later on and say, no, what I'm really saying is that loan demand is tepid because people are paying down their credit cards. So the banks are still not seeing a big surge in loans, which would give them a steadier stream of profit than what they're seeing. But here's what we're looking at. We're trying to figure out, as we go into earnings season, what stocks might go down on good news, because there's a huge amount of expectation baked into the stock market at this level. And we're trying to see what stocks might actually go up on unexpected good news. And one of the ones I've been looking at in that, on the stocks that might go up on unexpected good news, is actually Microsoft. One of the things that you should watch for in earnings season is when you get a report from a similar stock earlier than the stock that you're interested in. So SAP reported 2 days ago, first quarter, and they saw the fastest first quarter growth in 5 years. They saw a big increase in cloud revenue, 7% year to year. That doesn't sound like a whole lot, but given the fact that SAP has been talking about cloud revenue being down because people were not investing because of the pandemic, SAP has got a lot of European business, so it hasn't really recovered that market. And they saw the cloud backlog go up 15% year over year. So this is always all the good stuff for cloud. They raised their cloud forecast. So if you want to say, okay, this is a precursor, what does this mean? Well, it means that for cloud companies going forward, they might be able to beat even hefty expectations. Microsoft doesn't report until May 5th. The consensus is $1.76 a share in earnings. That would be up from $1.40 last year. So you're already looking at a 25 to 26% estimate increase year-to-year earnings. On the SAP news, I think there's a good chance that they could beat it. So this would be one stock that I'm looking for. I like Microsoft for the long term, but if I'm looking to pick up maybe some short-term profits, playing Microsoft as a trade, maybe buying some call options here to pick up to sort of leverage the increase would be a possibility. Another thing to look for during earnings season, and this comes from a stock, a tiny little consumer goods stock you might have heard of, called Procter Gamble. Procter Gamble reports earnings on the 20th, but they've already come out and said, hey, we're going to increase our dividends. That companies don't do that if they think they're going to see shaky results. And that we're going to continue our stock buyback program. We're going to buy, in fact, $10 billion worth of shares in fiscal 2021. So we're looking at very, very good numbers on the sort of the forecast, the expectation. What's interesting here is that the actual Wall Street expectations aren't very high for increase in growth. That they're looking at $1.19 a share for the first quarter, and that would only be up from $1.17 a year ago. So there's a chance here that given what Procter & Gamble has just said about its dividend and its share buybacks and the confidence that you might sense in that they're going to be able to beat expectations. So it's another one that I'd look for. You'll see that recently, the stock really hasn't been doing much of anything recently, is really the last 2 weeks. So again, they're sort of waiting on earnings is my sense that we're seeing a lot of that going on in the market. Last one as an indicator might look at is Apple. Now, Apple is a very hard stock to judge right now because there's so much news going on around it that Apple, for example, and a lot of it is shortage of components. So Apple, there's news that Apple may be finding a shortage of components for its high-end display screens on the MacBook. There's, of course, the chip shortage. So Apple reports on the 28th. Wall Street says they're going to report 99 cents instead of 64 cents last year. So a good growth rate there. You notice that Apple's been going up to reflect that, and then it's sort of stalled as we wait for earnings on the 28th. I would actually find another stock a more interesting way right now to play Apple earnings, and that's a company that's an Apple supplier called Skyworks Solutions, and they report after Apple. So Apple reports on the 28th, Skyworks reports on the 3rd. So you got some chance to have Apple move Skyworks, and Skyworks really does move along with Apple. What you're looking at here is really big expectations. So Wall Street is saying, hey, $2.08 a share this quarter, up from $1.12. So you're really looking for, if we can get good numbers out of Apple, the possibility that Skyworks would be able to beat those expectations is certainly in there. I'd certainly give Skyworks a look in the short term on the Apple news on the 28th, looking forward to Skyworks earnings on the 3rd. It's not always positive in this. You can get a sense of where there might be trouble going forward. So like, for example, there's a company called Fastenal, symbol is FAST. They make screws, bolts, fastenings for the industrial market. They basically came out and said, hey, we met expectations, but they didn't increase their earnings. So one of the things here is that maybe the building and construction sector isn't going to beat expectations in the quarter, and you might want to take that as kind of a warning for short-term plays. Earnings season, remember, is going to be very, very important this term. You've got a stock market that's trading at huge multiples and is betting on a 20 to 25% increase in earnings this quarter, and then a 50% increase in earnings. This is year-over-year growth in the second quarter. One of the reasons they're so high is you're getting these really interesting year-to-year comparisons. You're basically comparing recovery quarters with recession quarters from 2020. So you see this kind of growth in earnings year to year, and the market is really counting on those. So it's going to be a very volatile time for a lot of companies, but I still think that as long as these earnings growth numbers come in, we're not going to see a big market pullback here. That I think depends on later in the year with what the Fed is doing. If you like this video, please give it a thumbs up. And please consider subscribing to my YouTube channel. It'll give you a notification of when the next one goes up in about a week. And you can see more of my stuff, not more of me, since it's all written stuff, on my free site, jubakpicks.com, and even more, 6 portfolios instead of 3, some options plays on my subscription site, that's jubakam.com. So thanks very much, and see you next week.